So if this has got resistance at 45, support at 40, 250, and 40, I want to now say if I'm going to do some type of a trade, I wouldn't buy a call because I'm already at resistance. I'm ready for a little pullback. I wouldn't buy a put, definitely, because this is in-end uptrend. So I'd be looking for some type of bullish trade that allows me to reverse if necessary. So let's look, let's go out to the September options. Just click right down here where it has September. A couple of September options and just see what the prices are available for us. Okay, so right now we've got September. Now it's got $1 strike price. Is that helpful?
Yeah.
Very helpful. I was hoping it didn't, so I could show you why you wouldn't want to place a trade with Film School. Let's say that the stock had only $5 strike prices. So if that was the case, you'd probably sell the $40 put and buy the $35 put for a bull put spread for this one here because it's about to pull back a little bit. And so if it does pull back to about 40 as it's down, you'd still be okay on that type of spread. And then you want to say, well, how much am I going to get paid for that? It's going to work out for me. But let's say you were wrong and you sold the $40 put and you bought the $35 put. Well, if you're wrong on this trade, and I'm going to throw out some numbers here, so go ahead and write them down so it makes more sense. I'll do it in my head because it's what I do. When I do it in my head, I lose you. And so why don't you just write them down on paper. You're going to sell the $40 put. Now, I'm assuming there was $5 strike prices versus the ones here. And you're going to buy the $35 put. Now, because the stock is currently trading, I'm sorry, this is the Qs over here, Matt.
Sorry, what?
These are the Qs.
Oh, what do you want?
I wanted
CSX.
CSX.
Oh, sorry about that.
Okay.
I don't know how it defaulted.
It defaults to that quite often. CSX. And then we'll pull up September options when they come back. Good, still $1 strike price. Excellent. Okay. So now, and then we'll just make sure we're on September's up here.
I think we are.
Oh, we are there. Okay, perfect. Okay, thank you. So now, so I'm going to make these up. So you sell the September 40 put for $1. Just write these numbers down. And you're buying the September 35 put. What type of spread is this called? Many names you call it bull put spread, or you say I'm selling a put spread. Selling means you have more coming in than going out. Put means you're using a put spread. So we call selling a diagonal, selling a vertical put spread is what it is. So that's the technical name. Most of us just call them bull put spreads. Everybody understands that. It's like saying I want a Coke. Somebody brings you a Pepsi, you might be okay with it, you might not, but it just means you're not asking for a spread. All right. So now, you sell September 40s for $1. You buy the September 35s for 25 cents. I'm just throwing these numbers out just blindly here. So what's your total credit for this trade?
75 cents.
75 cents. Now, in order for this to work, you need the stock to do what?
About 40.
Stay above 40, and it expires worthless. But as long as it stays above 39.75, will it still be okay? But you really want to stay above 40 so it expires worthless on it. Okay. Stock starts to pull back, comes back to 40, and now the overall markets themselves also now start to sell off. So the stock, not with any real volume, excuse me, and usually volume is where I usually make my changes. If the stock breaks through a support on a volume spike, that's when it's going lower. Now, I can do this all day long, and I'm not going above the ceiling. When will I go above the ceiling? When I really get strength behind it and I really push through, I'll go through the ceiling. Well, that's what a stock needs to go through its ceiling or its floor. It needs the volume spike. So the stock pulls back to about 40, just kind of floating around there for a couple of weeks, not doing anything. Now the markets finally get their pullback we've been waiting for. And the stock starts to drop beneath 40. Yes? It's now pulled back to 39. Where's it going? Starting to drop now, yes? So at this point, we'd say, well, the reason I got into a bull put spread was just in case I'm wrong, how do I reverse a bull put spread, which is bullish, into a bearish trade? Let me see. I sold a 40 put, and I bought a 35 put. So if I just buy back that September $40 put, what's the only thing you have left in your account?
The long
A September $35 put. Well, if you own a put, is that bullish or bearish?
Sure.
Okay, good. So now the stock's at 39, and you're going to buy back the September $40 put because it just broke that support level. And now that it's at 39, what's the $40 put got to be worth at least? Stock's at $39, and you're going to buy the $40 put to close out that trade. That's your worth $1. It's a buck. Plus some. And can you use the Greeks to tell what the time value should be? Market makers are making whatever they want, correct?
Right.
If there's a lot of volume on there, they're not going to give you anything. If there's not very much volume, they're going to put a whole bunch of open issues. They'll do whatever they want for themselves to make a profit. So let's just make up a number and say, if you bought those back right now, it cost you $1.40. Now you're going to buy back, you're going to buy to close the September $40 put for $1.40. What was the original credit in your account? 75 cents. So now, what you have in your account right now is you own the September 35 put you paid 75 cents for, correct? Now, in order for the stock to mandatory be profitable, or this trade to be profitable, the stock has to drop 75 cents past $39 because you paid 75 cents, I'm sorry, past $35 because you own the September $35 put, which, as the numbers show, you paid 75 cents for at this moment in time. If this stock pulls on expiration day, let's say you've got 2 weeks between now and the 3rd Friday of September, the stock continues to drop, makes it down to about $36 a share, and now finally stops dropping around 36 and starts to bounce. And on September expiration, the stock is back at $39 per share. Could that happen?
Yeah.
So stock only made it to 36, and now it bounced up to 39. So you paid 75 cents. When think about what happens when you buy a put. When you buy a put, you have paid money to force somebody else to buy that stock from you at $35. So because you own a $35 put, you could go out and buy that stock at its current price right now of $39 and force somebody else to buy it from you at $35. So you can buy it at $39 and you can sell it at $35. You can buy it at $39 and you can sell it at $35. How much are you going to make? You lose $4. And how much money did you pay to lose $4?
70.
You paid 75 cents so you could lose $4. Pretty decent trade.
Right.
Ooh,
You paid 75 cents so you could lose $4. I don't necessarily think I like
that's
that.
good.
That probability of success doesn't work for me on that one, right? So we're going to change that. So part of what I was trying to get to here is saying that if the strike prices don't allow you to make a profit, you might not make a profit. That's where the $1 strike prices are helpful. Makes it much easier. Even when that stock pulled back to $36, what's the $35 put have to be worth right now? Have to be worth. Stock's at 36, and you paid money to buy a $35 put. What could the price of the option be if the stock was at $36?
$1.
$1.
No, it'd be 0.
Oh,
So you're
Whatever
paying
time.
money. You're paying money to buy something at 36 and sell it at 35. I'd like to give you money. Change it. You would like to give me money so that you can go out and buy something at 36 and sell it to me at 35. I'll let you pay me as much money as you want to do that. I want you to buy something at 36 and sell it to me at 35. How much money are you going to make if you buy something at 36 and sell it to me at 35? So how much are you willing to pay me to do that then?
I don't want
Nothing. That's the point. So even if that stock drops all the way down to $36, what's the $35 put have to be worth? 0. It doesn't be worth anything. So even if you're right because you own the put, the strike prices didn't allow you to make any money. Wow. So what's the value of doing a put spread to begin with then? Huh. So that's why I'm saying if the options don't allow you to reverse the trade, you still can't fix that trade. So the best way to make money on a trade and make sure that you're going to make a profit if you have to fix it is you have to have the ability to fix it. This stock has got what kind of strike prices? I love $1 strike prices. The more volume a stock has and the more we're in the marketplace, the more these $1 strike prices you're seeing. What's really nice about ETFs, ETFs have what? Electronic traded funds? What do the ETFs have? I'm sorry, exchange traded funds have what?
$1 strikes.
Okay, so now the stock we're looking at here is at 44.33 right now. It's at 44.33. The stock could pull back a little bit, maybe to about $40 a share, we say. Next, probably 42.50, and goes through 42.50, then 40. Okay, that makes it much easier for me. Now I'm okay with doing a put spread here because now if I'm wrong, I have to change it. I don't have to use a $35 strike price. I could use a 42.50. Right? I could use a 42.41. Because now if it goes through 40, where's it going now? It's starting to drop off. Let's change that now. Let's see right now, if I were to sell the $42 puts right now, how much could you get if you sold the $42 puts? $1.60, correct?